Hello there and welcome to Homeschooling Adventures. My name is P. Jeremy, and in today's video we are going to be looking at our balance of payment account. Now someone might be asking what is meant by the balance of payment. A balance of payment account is a systematic way of recording one country's transactions with the rest of the world. I'll give you an example. Take for example a country like South Africa selling or trading with United States. Now they are going to be recording all those transactions that they do with the United States in a certain way, and that way is what we are referring to as a systematic way of recording. Okay, so it can be South Africa trading with the United States or Australia or Saudi Arabia or any other country that we are trading with. We record all that in an account that is called a balance of payment. Now, our balance of payment, dear learners, is divided into three accounts. The first set of accounts that we find in a balance of payment is what is called the current account. Now, in our current account, this is the account where we are going to be recording the goods that we have exported. Okay, when we export goods, remember exports is when South Africa sells goods to another country. Okay, now those exports, when we export goods, we are going to record it in what is called the current account. But in our current account, remember learners, the goods that we are talking about, we are looking at things like net gold exports. We are looking at things like service receipts. We are looking at things like income receipts. Now, when we talk about service receipts, you need to understand that service receipts is money that we have received us as a country when we rendered a service to another country. Okay, so the amount of money that we are going to receive from services that we have offered to another country is what we call service receipts. And then we also have things like income receipts. Now, when we talk about income receipts, we are saying this is an amount of money that we have received us as a country. Probably, I'll give you an example of maybe a South African company that is operating in the United States. Now, at the end of the year, we now know that the company that is operating in the United States, if it makes a profit, it can possibly declare a dividend. Now, if it declares a dividend, then the shareholders who are South Africans are going to receive dividends from the United States because their company that is operating in the United States has operated profitably and has decided to pay its shareholders a dividend. So that amount of money that is going to be received is what we call income receipts. Okay, so we all record that in our current account. So we said you record gold, net gold exports, net gold exports. You are also going to record what I said, service receipts, which is the amount of monies that we have received when we offered a service. We also record service receipts. Okay, the other thing that we are also going to be recording there is what we call income receipts. Okay, and in this particular case, I was looking at things like dividends that are declared by a South African company that is operating in the United States. Okay, then we also, now all these receipts, because these are monies that are coming in, okay, so we record them as additions. So we are going to be adding these things in our current account. They are treated as additions because these are monies that we are receiving as an economy. And then we are going to subtract, still in the current account, we have added these three. Then we are going to subtract things like merchandise imports, which is the goods that we are buying into our country, okay, from the rest of the world. In other words, we are buying goods from the United States into South Africa, then we take that to be merchandise imports. And these merchandise imports, we are going to subtract them because remember, when we buy goods, we are going to be paying out, okay? So we are going to be subtracting those merchandise imports. So imports, we are going to subtract. Okay, then we are also going to be subtracting things like payments for services. I'll give you an example of payments for services. During COVID, the South African government realized that the health services is under strain, and the doctors and nurses could not cope with the level of pressure that was coming with the pandemic. So what they had to do was they had to bring doctors, medical doctors from Cuba into the country to try and support the health staff that we had in our country. So what it ended up resulting in is it created a need for South Africa to make a payment to Cuba, okay? Because they are receiving a service from Cuba, and then they've got to pay for that service that they are receiving because of the Cuban doctors that are now resident and working in South Africa. So that results in what we call payment for services. So payment for services is also going to be a subtraction, because when we receive a service, we are going to pay for it. Okay, so we pay for services. Okay, it's going to be a subtraction. And then we also record in our current account, we also record things like income payments. Okay, income payments. Okay, so when we talk about income payments, dear learners, what we are talking about is we are saying these are payments that are made by the company that is operating in South Africa but is not a South African company. Okay, let's take an example, things like a company like Old Mutual, for example. Okay, it's a multinational company, which means it's not a company that only operates in South Africa. But you find that even its head office is not from South Africa. So what happens is, should it make a profit, at the end of the year, it can declare a dividend. If it does declare a dividend, then it creates a need for South Africa as an economy to make a payment to the shareholders that are outside the country. So that gives rise to what we call income payments. Okay, these are things that we are going to be paying. Remember, income receipts are dividends that we are receiving, and then income payments are dividends that we are paying as a country to another country. Okay, then we also have then when you get to this, then we also have things that we now need to record, which are probably just a memo item, things like the trade balances. Okay, now this could just be an adjustment that is created to take care of any omissions that we could have made when we were recording these transactions. So it's just intended at taking care of those adjustments or those omissions that we could have made when we were recording the transactions. Okay, so that marks the end of our current account, and then we go to the second type of an account, which is also found under the balance of payment account, which is called a capital transfer account. Okay, so the second type of an account is what is called the capital transfer. Capital transfer account. Now, our capital transfer account, dear learners, you need to understand that this is an account that just records the net lending to, okay, or borrowing from the rest of the world. Okay, so our net lending to, okay, is going to be treated as a plus. Okay, because when we give something out, it's actually an income to us. Okay, because we are going to be receiving money for that. It could be a net lending. I will give you examples later. Okay, and then we also spoke about borrowing from. Now, when we borrow from the rest of the world, it's going to be treated in our capital transfer account as a subtraction, because that is an amount of money that creates a liability of the country to the rest of the world. Okay, now you need to understand that when we talk about the capital transfer, it records the transactions on grants, okay, that relate to ownership of fixed assets. Okay, to grants that relate to ownership of fixed assets. I will give you an example. Let's assume there's an NGO that is operating in the Netherlands. Okay, its head office is in the Netherlands, but is operating here in South Africa. Okay, so any grant that it gives to South Africa, okay, it could be a grant that is given to South Africa for maybe housing, for building houses for its citizens, or for anything else that is a fixed asset, okay, in the country. That leads to what we call net lending from the rest of the world, because this is an NGO that is in the Netherlands that has made a donation to our South African country. So it means that's net lending from the rest of the world, and that is supposed to be treated as a minus, because it's money that is coming from outside and is not ours. Okay, it's a borrowing. It's money that we have borrowed from outside. Okay, and then you would also find that we have what is called net lending too. Now, let's say we have an NGO that is operating in South Africa that makes a donation to a company or to Zimbabwe, for example, okay, or to Botswana or to Lesotho. Then we are saying that's net lending to, okay, the rest of the world. And then that is supposed to be treated as a plus in our capital transfer account. Okay? So in our capital transfer account, learners, you need to understand that we are going to be recording just the net amount. It will be when we have set off the monies that we are giving out and the monies that are coming in, then the balance is what we are going to record. Okay? That's why we are referring to it as net. Okay? Now, we also go to the third part, which is of the balance of payment, which is where we are recording our financial account. Okay? This is where we record now our financial account. Okay? That's the third account. Okay? Now, our financial account, dear learners, you need to understand that this one records just the net amounts. Okay? We only record the net amounts. When we say net, we are saying the difference having subtracted what we needed to subtract from what we have received. Okay? So our net, our financial account only records the net amounts. So it is going to be net of direct investments. So we record in our financial account net direct investments. Okay, we also record the other net, which is the net portfolio investments. Okay, we also record the other one, which is our net financial derivatives. Okay, and then the other thing that we are also going to record in our financial account is the other investments. Are we together? So we then record other investments that we have. Okay, and then you also need to understand that our financial account also records the last most important thing, which is called the reserve assets. Now, when we talk about reserve assets, we are looking at things like special drawing rights, which is called the SDR allowances. Okay, these are other reserve assets. Okay, so these are the things that we record in our financial account. Now, you now need to understand that when we have done this with our financial account, we get now the balance on the financial account. In other words, when you have recorded all this and then you edit those that you need to add, and the ones that needed to be subtracted that are negative, you then subtract them, then you get your balance on the balance on the financial account. Okay, and then when you have done that, now we now have other things like unrecorded items or unrecorded transactions. They also need to be recorded after you have recorded the three accounts, and then we have our unrecorded transactions. So this is our balance of payment account. Okay, so if you like the video, click the like button and remember to subscribe to the channel. All the best in your studies. And out.